All right, welcome back. We're on week 3, part 3 of 10. We're now in chart patterns, so we're using the information from significant levels and channels and trends to get these patterns. This will be a little more advanced than last time. It won't be too much more difficult. Chart patterns really, again, just use the fundamentals from the previous 2 classes. So getting right into it, the agenda for today is just what are chart patterns. We'll get into some chart patterns, some basic ones, how to find chart patterns, what are their win rates, what not to do with chart patterns. So just like channels and trends and significant levels, stuff that you don't want to do, get into some live charting, and then a Q&A and conclusion at the end. So starting off here, chart patterns are sections of a stock's price action in which candlesticks form a pattern with a predictable break. These require several candlesticks. This isn't something that you do on a line chart. You need those 5-minute, 3-minute, 15-hour daily candles to form these patterns. I would say you need at least probably 10 to 20 of them. Anything over that's obviously good. Anything over, I don't know, maybe 100 candles probably invalidates the pattern and just turns it into either trend or channel. So patterns are really just the use of trends and channels as well as significant levels, which we touched on for the first 2 classes. So if you look at the right here, we have some of your basic chart patterns: bearish double top, bullish double bottom, bearish head and shoulders, bullish inverse head and shoulders. You got all your wedges. You got your bear flags, bull flags, triple and double bottoms and tops, symmetrical triangles, expanding triangles. Looking at the channels and trends that are drawn in here. So again, channels are those sections in a chart where you have 2 parallel lines where the price action is confined between those 2 parallel lines. The trends obviously intersect at some point. And then you have your necklines on like the double bottom, double top, head and shoulders that are just significant levels that you can play breaks of. So getting into the first one here, head and shoulders, you have the inverse head and shoulders as well. Starting off with this because this is by far the most well-known chart pattern. At the cost of being this well-known, I mean, if you guys go on Twitter, YouTube, any Discord you ever go in, you're going to see people say, oh, is this a head and shoulders? Is this a head and shoulders? Most of them aren't. Some of them are. Because it's so well known, this chart has the lowest win rate. It's about, on the low end, 61% to 71%, which is disgusting. Still above 50%, meaning if you play it 2 out of 4 times, 5 out of 10 times, you're going to win. When you play this correctly, it does pay out quite well because the breaks are large because it's such a large reversal pattern. This is another big misconception too, is that people play this as a continuation pattern. They play it as a breakout pattern. This is only for reversal, so this is only at the tops and bottoms of trends, and I'll get into that in the live charting. This is not something that you want to play if the price action is going up and you see a head and shoulders form. It's reversing back down. It's not going to continue up. Those are other patterns that form. Most of the time, it's a head and shoulders that turns into a broadening wedge or a descending or ascending triangle. So the next one here, double tops and bottoms. And I included these pictures on the left because these are examples of not having a 100% win rate. You guys will see these patterns. You'll see them on the charts all the time. And again, they do not have a 100% win rate. No trader, no pattern, no candlestick pattern, no method of trading has a 100% win rate. This one does have about a 72 to 75% win rate. But on the left here, you can see it's an area where 2 tops form or 2 bottoms in the case of the double bottom with 1 bounce off a neckline. This is your significant level. The 2 tops are the top of the reversal, and the neckline is the support that it often breaks to the downside in the case of the double top, upside in the double bottom. But in this case, you saw it had a bounce could have gone up to form a triple top or triple bottom. So oftentimes, if these are fake outs, they'll go to form triple tops or triple bottoms. Anything over 3, it's just a channel or a trend. But in this case, this was a triple top and triple bottom, so I include these both on the same slide because they're so similar. But what you don't want to be doing is you don't want to enter before it breaks that significant level, because that is a point of invalidation. You're jumping into the trade early. You're predicting that it's going to go down, but you're not certain that it's going to go down. If it closes below that neckline, that significant level, then you're certain that it's going to go down. So these are also reversal patterns. I believe I mentioned that already. These are not something you play to continue up or down. These are, you play them at the top of trends, you play them at the bottom of trends. Next, we got the broadening wedges. There's several kinds of wedges. You have broadening wedges, ascending wedges, descending wedges, all that fun stuff. Megaphones, some people call them. These are ascending and descending patterns, so price action makes higher ranges as the trend expands. This is an ascending broadening wedge. This is a descending broadening wedge. Ascending, this one to the left, this breaks to the downside. Descending breaks to the upside. Win rate for these is about 78 to 82. These aren't all that well known. Something that you're going to notice is the more people know about the pattern, the less the win rate is. The more secretive or hidden the pattern is, obviously there's going to be people that know about it, but it's going to have a higher win rate. And take that how you want it. It might be manipulation or market makers trying to steal some of your hard-earned money. These are also reversal patterns, not continuations. You're not going to play these intraday to say the price action is going up. You're not going to play these to have the price continue going up. You're going to have these as a play that you reverse the price action on the day. Continuing off of that, we have wedges. So these are the opposite. I'm going to go ahead and go back to this. So you see the broadening wedge expands as the pattern goes on. And if you remember from last week, I said the significance of a channel or trend decreases as the trend goes on. The channel or trend goes on. So the further down the line you are, the price action isn't going to continue within the trend. It does have these breaks, and that's where these patterns come from. And that's why I did that channels and trends class first. So the descending and ascending wedges, these come to a point rather than broadening. So they're the inverse of the broadening wedge. They have a large or a higher range at the beginning, and then it gets tighter and tighter and tighter. Ascending breaks to the downside, so they're the same. Ascending breaks to the downside, descending breaks to the upside. Win rate for these is about 72 to 76% because they are a little bit more well-known than the broadening wedges. These are also reversal patterns, not continuations. Really want to hammer that point home for this first group of patterns. These aren't things that you're going to play for reverse, or these aren't things you're going to play for continuations. These are reversals, so that's another thing that helps you invalidate whether that trend or chart or whatever you want to call it, whether that is valid or not. So if you see a head and shoulders forming, but it's continuing up in price action, if the price action is already going up, it's not a head and shoulders, it's a different pattern, it's something else. That helps you invalidate or validate whether you're correct or not. So stepping into, I only have 2 continuation patterns on here. I feel like the other ones are a little too complex. They add a little too much confusion. So these are continuation. They're flags, bull flags, and bear flags. These are very well known. These are channels. They're either ascending or descending channels. You can see that we have the parallel structure on it, 2 parallel lines. In this case, I have 3 because I charted the wicks. I charted the wicks of the candles as well as the bodies. So this case, it did break, but we tapped where the wick was on the bottom. So these are the channels. They have a higher percent win rate because I believe channels are more significant than trends. The parallel lines are more significant because they're often a lot more correct. You chart them easier than you chart trends. With trends, you can alter your trend line over and over again and you can often be within the same trend. You could also say that the pattern on here that I charted could be a broadening wedge with a break to the downside. I'm just going to say this is a bear flag to your left, a bull flag to your right. So bull flags are ascending. The price action is going up. It forms a descending channel. The price action breaks the direction that the channel was formed. So we came up into the channel, formed the channel. The price action breaks the same way the channel was formed. Same with the bear flag. We came down into the channel. Price action breaks the way the channel was formed. These have about a 75 to 83% win rate. And again, I believe that is just because the channel is more significant than a trend. And then lastly, we have the cup and handles. This is also an inversible pattern. So like the head and shoulders, there's an upside down version of it. Price action will form a curl followed by a bull flag or bear flag. This creates the handle. So these are continuation patterns. As you can see, the price came up, it curled down, making the bowl or the cup, and then it made a bull flag here on the side. It's a descending channel. The channel was formed by upward price action. It breaks to the upside. Same with the descending version. Price is coming down, curls up, makes a bear flag, and then price breaks down. These can be played the same way. I don't really like playing cup and handles. I have my moments with them. It's difficult to draw the cup because there's no tool that you can draw like a perfect half circle. It's usually free-handed, and then it turns out just being a bear flag or a bull flag that you chart. But the cup itself is what makes it easier to spot. It really turns out to just be a bull flag or bear flag. So they're the same win rates because it's essentially the same pattern. These also have a neckline, so that's the significant levels from the first class. There's a combination of significant levels in the channels and trends on this one. Then we can get into some live charting here. So if you guys have any tickers that you want me to pull up, I'd be more than happy to do so. So this is a descending wedge, and it has a bullish break to the upside. Again, what I mentioned last class is you start, this is going to be a little difficult to grasp here. You start the lines from the same point. So this one was a little more extended out because it's a shorter line than the top one. So you start them from the same point. Price action is it's larger ranges at the beginning, and then it gets tighter and tighter and tighter, and then it has a break to the upside. Usually what happens, so I don't have a head and shoulders charted. Usually what happens with these as well is that you'll have a retest of the breakout point. So it eventually hits a resistance, and then it comes back down, and it will typically retest where it broke out. Sometimes not on the wedges because the descending line gets too far down for it to realistically hit that price. So most of the time it will just hit it whatever the next significant level is. Speaking of which, it looks like we might have a head and shoulders here on this chart. It's a little messy on the right shoulder, but it could be a breakout. In this case, if it was, so this is an inverse head and shoulders. We use the brush tool to just draw in the outline of it. So we have the left shoulder, the head, and then this could possibly be the right shoulder right here. You have your neckline, your significant level, which in this case it was that about 107.50. The ticker for this is CrowdStrike, CRWD. So the neckline on this was 107.50. You have your break. This is where you would enter calls because it's above the significant level. This is from the first class. You play this to the next significant level, which happened to be 118.21. And then you can either, again, raise your price target or just secure there, which is what I do most of the time. Head and shoulders, and this is what I wanted to touch on. Head and shoulders also have the same retest that most patterns do. So we'll have the breakout, and then it will retest whatever the neckline was. This is a event where resistance turns into support, and then it usually rockets back up. So you'll have the retest, you'll have a pivot from that retest, and then most of the time it bounces back up. And then at this point, you're just playing significant levels. Octa, I have so this is a broadening wedge, a descending broadening wedge. Price action starts tighter. It expands, making higher ranges as the wedge goes on, and then it has a bullish breakout. This one doesn't often retest just because, again, when it breaks out, it's difficult for the price action to come all the way back down to where the wedge was. So in this case, you could say this could have been a double bottom here, and then your entry on this candle, and then continue up. Double bottoms also do retest sometimes. So something else as well is you don't have to have a perfectly flat or perfectly symmetrical double bottom or double top. So the bottoms of the trend can be different like this. They don't have to be perfectly aligned with each other. The more aligned they are, the more accurate the pattern is, because human nature that we like symmetry. The more symmetrical something is, the more often it has a percent to, or the higher win rate it might have, just because the symmetric version or the symmetric life of it is nice. And then we have a just kind of mess right here. This isn't really any pattern. This is waiting for something to form, I'd say. Or you could go, so something else too is when you see a mess like this, not really anything formed here, you don't want to go and try to force something, be like, oh, this could be a cup and handle, and then we're expecting something like that. Something that I use as a rule of thumb for cups and handles: can you drink out of this cup? If the neckline of the cup is like this, or the rim is at this angle, no, because all the liquid within the cup is just going to spill onto your lap like that. So you want cups and handles to have flat necklines, and then the bear flag or bull flag on the end of it, if it's inverse or not. And then I'll try to look for, so these are all in daily time frames. I will go on to, let's try this chart, for example. So this one you can see, and you use the same method for last week that we did with the descending and ascending trend lines channels as well. In this case, you draw it from the same point. This is a descending broadening wedge on Roblox. That's why I just put the watermark back on there. So this is a descending broadening wedge. Price action started tighter. It's expanding as the wedge goes on. Eventually, this should have a bullish break, which will likely happen. It should happen at this point right here. The reason I say that is it's unrealistic for the price of Roblox to come all the way back down if it follows the time frame that we have on these trendline touches. So I'd say about a month from top to bottom. That would mean that it would be all the way back down at $17 a share. So that's from last week as well. The more time a trend or channel has, the longer it's in the trend or channel, the more invalidated it becomes, because it's difficult for the price action to continue at the rate in which it's going within the trend. And then we could say, this is a good example here too. So this could be an inverse head and shoulders that we spotted from, let's say you're charting back in June and you see this left shoulder, you see your head form, you get a neckline tap again, and then you get your right shoulder starting to form. This is an event that you don't want to enter early. You want to wait for that break of the neckline. which is this flat significant level here. You have your left shoulder, you have your head, and then you have your right shoulder that partially forms. It got rejected and then formed this broadening wedge. You don't want to be entering at these locations. You can. It's obviously going to be a lot riskier because you're trying to call the bottom of something that may or may not exist. So you always want to wait for that neckline break. This pattern should have broken. So if it did play out, it would have gone here first to the neckline. This is where that win rate comes in. So about 40 to 30% of the time, it will not break this neckline. It will reject and invalidate the entire what time frame was that? So it took from March to November. So it will invalidate that entire 7 months that it took to form. And then it will just, anyone that entered early, that counts as a loss. That's where that win rate comes from. Anyone that entered at the neckline and the neckline broke, that would count as a win. If it were a win, we would have continued up like this, hit the neckline, broke the neckline, done something along those lines, and then came back down eventually to retest it and pivot again from the neckline. So this is one of those places that you'd want to put a horizontal ray, which we use in the first class, because this is a significant level that we're not going to want to remove from the chart. Descending trend here, broadening, descending trend, should break to the upside. And then because we had this white line charted, a significant level, our expectation for a break, and we can also chart one here, you can see price action struggled to continue up both of these spots. Our expectation, if Roblox were to break this descending broadening wedge, is a retest of, or a push to 46.58, and then likely come back down and retest $40 flat, which is what it rejected yesterday on this chart. And then it turns into playing significant levels and waiting for another chart pattern to form. Is that making sense for everyone? So this is, again, you're just using the first two classes that we covered, and those are recorded, so you can go back and watch them. You're using the first two classes that we went over, significant levels in channels and trends, to form these chart patterns, because that's what makes them up. And then after they break, you just turn into trading significant levels and wait for another chart pattern to form along the way. So we can zoom in here again. And they're not always going to be pretty. They aren't going to be like the pictures that you saw on the slides. We could say that this might be a triple bottom here. It's at the bottom of a trend. We use the significant levels to chart a level at 38 flat. And then once I circle this, it should be a little clearer to see. So we have 1, 2, and then we have 3 bottoms. So 2 taps of the neckline, 3 bottoms, and then the breakout right here. Because it's over the neckline right here, this could have been a double bottom that got invalidated. This is a loss. So this is another example where the win rate's not 100%, obviously. So we go ahead and delete that. Not a triple bottom. That's our invalidation. And then we can say, hey, this might be a broadening wedge. And if they're symmetrical like this as well, whatever direction the direction the price action comes into the wedge, it breaks the opposite direction. So in this case, price action came down into the wedge, expanded as the wedge went on, and then we broke to the upside, continued right up to that next significant level, 46.58. And then in this case, because it's symmetrical, and something I forgot to mention for the wedges as well, because the wedges expand, it's much easier for the price action to retest with the breakout point. So for example, this is a descending broadening wedge. It would be easier for the price action to retest this if in contrast if the price was continuing down like this. So if this was a descending wedge, it would be more difficult for the price to come all the way back down to, say, 28.54 than it would for the price to come all the way back down to 38, 37, 38. So broadening wedges have a higher likelihood of the price retesting the breakout, the trend that it broke out of. So I would validate this being a broadening wedge because you have the expanding pattern, multiple touches on your trend line, which validates that trend line, and then you have your break and retest. So you can go and look at any 5 minute, any 1 day, 5 day, however long you want. You can go ahead and look at any chart, and you should be able to find, I'd say, at least one pattern a day. So Roblox today, you can go in. Something else that I like about chart patterns too is it helps you visualize where the significant levels are. So I did just chart that pretty quick. This on Roblox looks to me like a double top. We have two tops here, and again, as I said, they don't need to be perfectly symmetrical. And then we have 3 taps at the neckline. This little tap and rejection over here on the left side made it a little easier for us to find that neckline. And then it had the bearish break that we were looking for. So a double top, 2 rejections at the top of trend. It's a reversal on the 5 minute. Because it's on a 5 minute chart, the significant level isn't going to be validated unless we see another, like unless the price action curls up over here, hits that level, and then rejects and does something else like that. So you should be able to find about one of these on a 5 minute chart each day. I'd say there's at least one pattern, sometimes 2, sometimes 3. They also do, so the reason I have extended hours on it is because the patterns typically play out into the next day. You don't want to be playing them at that 30 minutes before close, 30 minutes after open, because that's when the volatility is high. It's going to be a lot more invalid or a lot more volatile. You're not going to have the higher win rates. But in this case, we can go ahead and chart this channel on Roblox. And this candle did invalidate that top trend, the top trend line of the channel. This is at a time of increased volatility, so the significance of this candle alone is less than the significance of these candles. So we have price action coming down, makes the bottom, and then bounces. This is a bear flag, and then we expect the price to break in the direction that the channel was formed into, which did happen. It carried over into pre-market the following day, and then price action continued on from there. But I would say this was a bear flag on a 5 minute. You could have swung puts. It's obviously going to be riskier than just playing the intraday move. Bear flag on the 5 minute, breaks down to the downside, and then forms a whole nother pattern the next day. Continued on to the next day, and the next day, and next day, and so on. So I'll go ahead and delete this. And the homework for next time, I'll just have you guys. We can do this Roblox chart since I've been on that. Go ahead on Roblox and find 5 chart patterns. Either go in the 5 minute or the 15 minute or whatever time frame you want, and then I'll try to get some posted there. And again, this is an example of it carrying over into the next day. So we have, I'd say, a double bottom here. This one's on a larger time frame, so this is probably 60, maybe 50 candles, and you can gather that by also doing the same method. I believe it'll show you the time frame, then whatever this time frame is. So this is over the course of 7 hours. You just divide 420 by 5 because we're on the 5-minute time frame. This is about 84 candles that it took to make this pattern. 80 to 84. So this, we have the neckline, carries over into the next day. Obviously, again, increased volatility at open, 30 minutes after open, 30 minutes before close. So it's increased volatility. It's going to be a lower percent win rate. But it was ultimately a double bottom. Avoid the first 30 minutes of trading. Avoid the last 30 minutes. Popped up to the upside. And then we can say it's at the bottom of the trend on this 5-minute. It doesn't have to be, because it's on a 5-minute time frame, it doesn't have to be the bottom of this trend from the previous day or the day before. We're just looking at this singular day. So I just gave you guys another one on Roblox there. Let's see if I can find one more. So this is the method I go about from finding these chart patterns. Let's see here. And this is also right here a good example of why the win rate's not 100% on all of them. So this pattern right here may or may not have been a bear flag. So we have the price coming down into the trend from here. Price came down, formed the channel. This channel should have broken to the downside and continued down like that. Instead, we spiked up the following day and completely invalidated that trend. So this is an example of when it's a loser. So the 25% of the time that this bear flag doesn't play out, and this is one of those times. So 1 out of 4 times on a bear flag or bull flag, you should lose. The other 3 out of 4 times, you should win. But that will conclude this lesson, and we can go into a Q&A here in a second. But again, homework for next time, go ahead and go on the Roblox, whatever time frame you want. Go ahead and go on the Roblox chart and find 5 different chart patterns. You can use the ones that I already pointed out, but that's not going to help you too much. So try to find ones that I haven't charted. But I'll catch you guys next week.